Are you close to retirement and trying to figure out how you're going to draw down your assets once you do retire? The shift in mindset from being a net saver to a net spender is a significant one that many need to make as they transition into retirement. And having a strategy can help alleviate a lot of the stress and uncertainty that comes with making such a significant transition. In today's video, we're going to look at one possible strategy you can use to do this. It's called the bucket strategy. And while the name, quite frankly, leaves a lot to be desired, it can be an effective way to think about how to structure your assets so you will never have to wonder about where to draw your next retirement dollar from. But first, allow me to introduce myself. My name is JP Geisbauer, founder of Centerpoint Financial Management. I'm a certified financial planner professional, a certified public accountant, and this channel is dedicated to helping diligent savers maximize their lives and minimize taxes as they transition into retirement. I create new videos weekly, so if you enjoy this content, please hit like or subscribe and you'll be notified as the new videos are released. The retirement bucket strategy is one way to manage retirement cash flow. The benefit of this strategy is that it provides for your short-term cash flow needs, allows for long-term growth, and helps your money last. This strategy involves segmenting your retirement savings into three distinct categories, or buckets. Each bucket serves a specific purpose based upon when you anticipate needing the funds within each bucket. In this video, we'll discuss the bucket strategy, the different buckets that should exist, the types of investments that belong in each bucket, and how this strategy can evolve during your retirement. And make sure you stay until the very end, when I'll be discussing the advantages and challenges of using this strategy. Once you get an understanding of how this strategy is supposed to work, you can customize and optimize it to fit your unique situation. What is the retirement bucket strategy? The bucket strategy divides your savings into essentially three categories: short-term, medium-term, and long-term. The time horizon for each of these buckets can vary with your strategy and preferences, but typically the buckets fall into the following three categories. Short-term bucket, funds needed in the next 1 to 5 years. Medium-term bucket, funds intended for, say, 3 to 10 years. And the long-term bucket, funds set aside for 8 years and beyond. Now you'll notice the time horizons I described overlapped each other, and this is because these time horizons should be customized to your preferences. So there's no hard and fast rule about how to structure this. Just beware that each bucket has its own unique investment mix, tailored to manage short-term cash flow, investment growth potential, and risk. So bucket number one, the short-term bucket. The purpose of the short-term bucket is to cover immediate expenses, such as living and lifestyle costs, healthcare, and potential emergencies. You could look at this as an emergency fund on steroids. You should be able to get at the money in this account almost immediately to cover any expenses that may arise. So what type of investments should you have in this short-term bucket? The principal goal of the assets in this bucket is liquidity and capital preservation. Common options include cash or cash equivalents like savings accounts, money market accounts, and treasury bills, short-term bonds, high-quality government or corporate bonds with low risk and low volatility, and short-term CDs. Why do these investments work in this bucket? With little exposure to market volatility, this bucket ensures you'll have money readily available for essential expenses as they arise. Bucket number two, the medium-term bucket. The purpose of the medium-term bucket is to help bridge the gap between short-term needs and long-term goals. The expectation is you will draw on these assets in as early as 3 years, but as long as 10. Again, these time horizons need to be tailored for your particular situation. What type of investment should you have in the medium-term bucket? This bucket seeks moderate growth while managing risk. So suitable investments include balanced funds, funds that include a mix of stocks and bonds to provide both growth and stability. Dividend paying and value tilted stocks. These offer income through dividends with potential for capital appreciation with lower volatility. Intermediate term bonds. Bonds maturing in the intermediate term, which provide higher returns than the duration of the short-term bucket, but avoid the volatility associated with longer-term bonds. Why do these investments work in this bucket? The goal is to provide exposure to value-focused equities and longer duration bonds, which help balance risk and return for your medium-term needs. Bucket number three, the long-term bucket. The principal goal of the investments in this bucket is long-term growth and appreciation to combat inflation and help your investments last throughout your retirement. What types of investments should you have in the long-term bucket? This bucket seeks to expose the investor to potentially higher returns, but also higher risk. Suitable investments for this strategy may include growth-oriented stocks or ETFs, large cap, small cap, and international equities for maximum growth, real estate investment trusts or REITs. These provide diversification and income potential. And perhaps alternative investments, options like commodities or private equities for sophisticated portfolios that have a longer commitment period. Why do these assets work in this bucket? With a longer time horizon, this bucket can withstand market volatility and harness compounding growth. But there is a certain amount of risk tolerance you must be able to accept with the assets in this bucket. So make sure that you have the intestinal fortitude to endure the ups and downs the risky assets in this bucket may put you through. Now that we have an understanding of the type of assets and investments that belong in each bucket, it's important to understand how these buckets work together. While it's easy to think of these as three separate and distinct segments, there's more fluidity to it. Because the reality is that these three buckets are interconnected, functioning almost like a waterfall. As the short-term bucket depletes, funds are replenished from the medium-term bucket. Then as the medium-term bucket is depleted, it is periodically refilled from investments from the long-term bucket. Let's take a quick example. Let's consider a couple retiring with $2 million in savings. They have retirement income in the form of Social Security, a pension, and rent on a residential investment property. Given their projected cash flow needs, they anticipate needing an additional $50,000 a year to maintain the lifestyle to which they have grown accustomed. So in starting out their strategy, we'll look at something like this. A short-term bucket of about $200,000 in cash and short-term bonds to cover 4 years of cash flow needs. For the medium-term bucket, we'll say $300,000 in a mix of balanced funds and dividend stocks, providing growth and income for the following 10 years. In the long-term bucket, we'll allocate $1.5 million in growth-focused investments for inflation protection and future needs. Our couple will periodically balance by moving investment income and gains from their medium-term bucket to the short-term bucket. Similarly, when the medium-term bucket needs replenishing, they will move funds from the long-term bucket to the medium-term bucket. They will also need to periodically evaluate the $50,000 per year number to ensure that it will still meet their cash flow needs as time progresses. And if they determine that they need more, they will need to adjust the amounts in the buckets accordingly. So what are the advantages of the bucket strategy? Number one, peace of mind. Having a short-term bucket reduces the stress of market volatility. It also provides you with a pool of available cash so you won't have to worry about making decisions to fund short-term cash flow needs. Number two, it's customizable. Everything from the time horizon for each bucket to the investments that belong in each can be modified based upon your individual goals and risk tolerance. There's no one-size-fits-all, allowing you to create the structure that works best for you. Number three, systematic withdrawals. By creating a system for withdrawing assets, you create an unemotional way to rebalance your buckets. This takes much of the emotion out of the decision and helps you minimize the mistakes of decisions driven by emotions. Number four, avoid selling distressed investments. One of the biggest benefits of this strategy is that by projecting your cash flow needs, you will hopefully never be forced to sell assets while the market is under great distress. If there are wild market fluctuations, you can use the assets in the short and medium-term buckets to meet any of your near-term obligations. This optionality gives the more volatile assets in the long-term bucket the opportunity to recover in the case of significant market disruptions. What are the challenges of the bucket strategy? Number one, inflation risk. There is some inflation risk associated with this strategy. While the assets in the short-term bucket will be invested and earning the highest rates possible for cash and cash equivalents, it's possible the earnings will not keep up with inflation. If that was the case, then you could possibly lose purchasing power during the years you were holding the safe assets. And while this is mitigated by the assets in the long-term bucket, it could provide some cause for concern for retirees during periods of heightened inflation. Number two, complexity. Some people may consider this strategy too complex. It definitely requires some work. From projecting your expenses to knowing which investments to use in each bucket, it just might take more than what people are willing to invest. Number three, Tax location. The bucket strategy on its face is tax location agnostic. What do I mean by tax location? I mean the type of account in which your assets are located. After tax, like a brokerage account, pre-tax, like a 401k or other retirement account, or tax-free, like a Roth. Additional attention must be paid to the tax consequences of drawdowns on pre-tax accounts or the selling of assets to generate cash in taxable accounts. It's important to note, $1 million in a pre-tax 401k account does not equal $1 million in cash once you factor in the income tax consequences of the related distributions. Number 4, market timing. The act of selling certain assets to buy others introduces an element of market timing to this strategy. You may be reluctant to sell during a down year for fear of locking in the losses. Or if the markets are going strong, you may be tempted to just let it ride. It's not like there's going to be the perfect time to make the necessary adjustments. So you may have to force yourself to eliminate the temptation to buy or sell based upon market performance rather than just sticking to the strategy. So is the bucket strategy right for you? The bucket strategy is a good fit for retirees who value structure and seek balance between growth and safety. It's particularly effective for retirees that have additional sources of income, like Social Security, pension, rental property, or even part-time or consulting work. This ongoing income can help reduce the amount necessary in the short-term bucket and allow the assets in the other buckets to grow. And while this bucket strategy provides some solutions for those in retirement, it's not necessarily foolproof. There are some challenges that need to be addressed when deciding whether or not the bucket strategy is right for you. Working with a financial advisor can help guide you through these challenges to ensure your strategy and the way your strategy is implemented is consistent with your overall retirement plan. I did another video on the questions you should ask a financial advisor before hiring one. It offers some great insights, and you can find a link to that video here. If you made it this far, thanks for watching. If you enjoyed this content, please hit like or subscribe. Thanks again for watching, and I'll see you next time.